Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to another episode of the What Matters podcast, the show that explores the world of wealth management and financial innovation. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And today we're joined by an industry disruptor, Gil Baumgarten, founder of Segment Wealth Management. Gil's fee-only fiduciary firm, Segment Wealth Management, is a top 20 firm in Houston, as ranked by the Houston Business Journal. Barron's ranks Gil a top 25 advisor in Texas, and Gil is also the best-selling author of Foolish: How Investors Get Worked Up and Worked Over by the System. Welcome, Gil.
Thank you. Glad to be here.
Gil, your journey and contributions to wealth management landscape are truly groundbreaking. To begin, let's dive right into your remarkable story. So you've been a pioneer in wealth management. You started your career in securities and investments back in the early 1980s, and you left the brokerage world, if I'm not mistaken, in 2010 to begin Segment Wealth. Can you share your inspiring story and journey from the beginning days, and then the story that into building your RIA? What led you there?
Well, I had some issues with some conflict with sort of the brokerage business model. And over the years, I kind of determined that the fiduciary side of the business was really where the wind was blowing. And that seemed to be better aligned with the way I preferred to treat my customers. And I just thought I had better value alignment with the RIA space. And so in 1994, 10 years into the business, I started investigating it. I just didn't think that my practice was big enough to make a leap of faith like that. And technology at the time was really not that good. And I really didn't have a place to land where I felt comfortable that I could take my fledgling, 75 million of assets or whatever I had at the time and try to cobble together a business out of it. So I waited 16 years till 2010 to finally take the leap when technology had improved quite a bit and my book of business was substantially bigger. And I felt that the risk of making that type of transaction or transition, if you will, was a lot less risky for me. So that's why I waited so long. I wish I had done it sooner.
That's not the first time I've heard that.
That's great. So your role as an ETF pioneer has been recognized by Barron's and the Wall Street Journal. Can you tell us more about the evolution of ETFs and your place as one of the top ETFs thought leaders in the U.S.?
I used to do a lot of a particular service when I was at Smith Barney called Track, and there was another version of it called PACE at UBS, which were tactical mutual fund allocation programs where mutual funds were used as an allocation tool based on a financial planning type model. But I just felt that the system was sort of laden with fees at the time that could approach 3 percentage points per year. And in a 9% long-term return world, I just felt like clients weren't getting a fair enough shake. And when ETFs sort of came on the scene in the mid-90s and became much more prolific in the early 2000s, I petitioned my firm at the time to let me run discretionary, fee-based 100% ETF portfolios, and they resisted primarily because they didn't want to give up their fee-rich 12B1 business, and they could see the handwriting on the wall that since ETFs didn't contain a 12B1 and the brokerage firms were so ingrained with the mutual fund business through pay to play and back scratching and a lot of the things that happen behind the scenes, they were very resistant to me running discretionary ETF portfolios because client fees would collapse. And that was really what I was after, was pushing client fees down below 1%. And the system really wasn't built very well to endure that. So eventually they relented and let me run the part of the pilot program for it. And today it's a very prolific part of the business, both in the brokerage space and in the RIA world. So that's what kind of led me here.
Yeah, you know what? You're probably the third podcast that we've done in the last week of different RIAs that have launched their own ETFs. If you don't mind me asking, um, what does your specific ETF or ETFs that you have at your company, what do they focus on?
Well, so we don't run ETFs per se, but we use ETFs as an allocation mechanism in the portfolio construction process. So we run a 60% broad market based ETF tactical allocation type program. So that would have QQQ or IWF or IWD, iShares, Vanguard products, those types of vehicles are the 60%, if you will. Then we trade the periphery around that 40%, which could be an overweight to healthcare, overweight to aerospace and defense, or financials. Right now, we're overweight to energy. So we try to keep as much of that core portion intact as possible because we don't want clients to pay realized gain taxes. In the end, our leg up on much of the competition is that we manage for unrealized gain, and the deferral of that is a lot more valuable to me than the tactical advantage I would have by trading client portfolios. So that's the reason why we have it constructed like that.
I like that. So kind of protect against paying lots of taxes.
That's exactly right. And in the ETFs that are broad market based, the fees are exceptionally low. So in that 60% component, I would guess that the average internal fee to the ETF is probably under 9 basis points.
Oh, wow.
And then in the 40% that we trade around the periphery, it's probably more like 50 or 60 basis points. So that gives the client a pretty decent shake of having a 18 or 19 basis point kind of a friction rate, if you will, and still be able to manage the taxes underneath it. So that's how we look at it.
That's fantastic.
Yeah.
And I wanted to ask you, as an entrepreneur in the wealth management space, what are some of the most valuable lessons that you've learned along the way?
Well, I should have taken risks in my business a lot sooner than I chose to. I didn't start my business till I was 51, but I've been in the brokerage business since I was 25. So I spent way too much time dealing with reconciling the issues that made me unhappy. One, working for a big firm, and two, working for a big firm that looked out for itself, what I perceived to be first. And I just needed to be more client centric, and the fiduciary side of the business makes a lot more sense for me. On top of that, I really did not like FINRA registration. Most of the problems that I ran into in the brokerage business from a regulatory standpoint had to do with their FINRA registration, and I really wasn't even doing FINRA regulated business. I was running a pseudo RIA inside of a brokerage platform, and you can imagine what kind of disconnects would arise from that. So I really needed to fix the structural issue of me complying with SEC rules, but trying to do that inside of a FINRA regulated business was just generally incompatible. So I ultimately had to make the switch to straight RIA.
Well, the story about Colonel Sanders, right? He didn't gain his wealth until he was almost 80 years old.
Exactly right. So yeah, I guess 51 is close enough.
So, was there any pivotal moments that really, made you leave Wall Street to say, "Hey, I'm going to go and open up my own firm"?
Yeah. So I was standing in the hallway leading from my office to the restroom, and I ran into my boss along the way, who was my branch manager. And I was grousing to him about the firm trying to make me do this or that. I think at the time they had some mandate that I had to open new checking accounts for a certain number of clients or get charge cards added. They were trying to take the banking side of the business and jam it down the client's throat. And I just didn't think that that was worthy of spending my time to do that. And I was complaining to him about, why should I have to do all this? And he looked me in the eye and said, "You know what your problem is? You think you work for the client. You work for the
Work for
brokerage
us.
firm. And the sooner you realize that we're the ones that butter your bread, the better off you're going to be." And I looked him right back in the eye and I said, "You and I aren't even in the same business." And he just had this blank stare because he knew what was coming. And it wasn't too long thereafter that he got, I guess, a little wise to the fact that I might be thinking about going straight RIA and packing up my business. And he wanted to remind me, how the relationships were owned by the brokerage firm, and I didn't own those relationships. And if I had any bright ideas about taking my discretionary book of business on the road, that I should think twice. And I told him, well, the problem for you is that you're going to sooner or later get the opportunity to prove your theory as to who owns those relationships, because when I leave, you're not going to keep any of them. And so, anyhow, he and I parted ways soon thereafter, and it was the best move I ever made.
Oh, that's awesome.
Yeah, that's great. Are you able to go into I want to hear a little more detail about, leaving that and going to start your own firm. You were already there for 30 years. I mean, there had to be some challenges, or you took a huge risk by doing this. Can you go into a little more detail about that
sure.
moment?
Well, the 2008 market meltdown that happened 2 years before I left UBS really obliterated a lot of my financials. So I had probably $1 million worth of stock options that at the time UBS stock was maybe $80. I think the stock went to 10. My strike price on my options was between $25 and $30. So here I am having lost a $50 in the money amount, and now I'm $20 in the hole on my stock options. My restricted stock that I owned had gotten trounced. So I probably lost $1 million in the stock meltdown, and all of my golden handcuffs had pretty much evaporated, because that's really what they were using to tie me to the firm. And I had seen the handwriting on the wall years earlier, like I said, back in 1994, and I started running discretionary books of business on those platforms, both at Smith Barney before I went to UBS in 2000. And when I left UBS in 2010, I had already built up a pretty sizable discretionary wrap practice. And the primary reason why I did that is that I didn't find much value in the wrap account business, where out of house money managers are collecting fees and not generating any alpha to speak of, and creating tax friction also, by the way. I really needed to control that. And I found that once you start running a discretionary book of business and the clients know that you're the one pulling the trigger on the individual names that you own and how you structure the portfolio, the ability for another broker in the office to compete with you when you pack up and leave, that's very, very difficult. It's hard enough to compete with somebody who's been doing it for 25 years at the time, but to have a 10-year-old fledgling discretionary practice that's pretty much being run that way inside of a brokerage firm is extremely difficult to pry those client relationships away from the departing broker and try to retain those. And I knew deliberately that that would make me very difficult to compete with, and a very prominent reason why I chose to build my discretionary practice at that brokerage firm, to make it very easy for me to transition that to an RIA platform.
So before Ashley delves into the next question there, because I want to hear a lot about Foolish. So you said you had about several 100,000 to $1 million. Was it in calls that were expiring?
Yes. I had employee stock options, and so my stock options at the time when I left in 2010, they vested in 2016, 2015, and there was a time back in 2008, 2009 that I had about $1 million worth of UBS stock and options. And then when the market crash occurred and UBS stock went from, I don't know, $75 down to $10, not only did I lose 85% of my stock, my options went to zero, because my options were exercisable at $25 or $30 a share when they were $70. Here I am, nearly $50 in the money, and when I blew through that $25 or $30 strike price and the stock's trading at 10, my options went to zero. So that's how I really got crunched. And I thought, well, how willing am I to, well, let me back up. I'm running a very stable fee-based type business that doesn't have a lot of volatility to it. And here I am investing my net worth in a company whose stock got obliterated primarily from their financial exposure to mortgages, bond trading, investment banking revenue. There were a lot of parts to the financial equation that made UBS's business way more risky than my business. And here I am allowing the equity value of my personal book of business to be resident, and I'm swapping my equity for their equity, and their equity just about got obliterated. And so I had a really hard time reconciling in my mind why I should continue to take that risk and why I shouldn't leave and form my RIA in which I could own my own destiny and swap their stock for my stock. And it turned out to be a much better equation for me.
Gotcha. Thank you.
Wow. That's really that's I'm gonna mark that. I am tripping over my words there. I'm gonna
Okay.
mark the clip there. Sorry. I was gonna go into your book. Okay. So you're also a best-selling author of Foolish: How Investors Get Worked Up and Worked Over by the System. Can you give our listeners a glimpse into the book's premise and what motivated you to write this book?
Well, when I first started writing the book, I created sort of a table of contents. And I was going to talk about how do annuities work? How do mutual funds work? How do all these different products work? And there was not really anything other than just being transparent about it. There wasn't anything insightful or new about it. Many books had been written like that. And I hired my daughter to help me write it. She had just graduated from Pepperdine and had a communications degree, was a gifted speaker, gifted writer, and she had a time in her life where she was just ready for something new. So for a year and a half, I hired her to full-time help me write the book. And as we were going through some dictation and some putting the words together, she kept I guess coming up with the conclusion that we really should be focusing more about how does the brokerage industry operate? What do they do? What do they do that they probably should not be doing if trust was their ultimate goal? How does all that stuff work from the inside? So about 40% of the book is how the brokerage system operates, and just some personal anecdotes about how I interacted with that system. And then the back 60% of the book is about investor psychology and ego and decision making and bad patterns that we see and prior family life, how you grew up. Dad's baggage with money kind of gets translated to the kids' baggage with money,
Right.
and just personal experience that I have had dealing with clients who had a um, I guess a scarcity versus an abundance mentality, and how they come to a bifurcated fork in the road really quickly where they have to choose preservation over future wealth accumulation, and the type of personalities that I saw kind of fall into these traps that repeated themselves over and over again. And so I wanted the back half of the book to be kind of about how to recognize those bad behaviors and kind of ward off against them.
I'll tell you this. I have to get a copy of your book, because it will relate to lots of bad decisions that I've made in the market.
Yeah, me
And
too. And I'm not
it,
pointing fingers at this. A lot of this is just personal anecdote about the mistakes that I've made, and I see it in other people too. So just trying to make people better decision makers.
right, because you're so right when you say a lot of it goes with ego. And the funny part about it was when I had, prior to being in this space, I was in the mortgage space along with Ashley. I had been in this space for 27 years in the mortgage-backed security world, and having sold my ownership in the company and moving, I had 3 years of where I was trading stocks and investing in stocks, picking practically every wrong one. I got to tell you that there was an actual psychologist in Vermont that specializes with investors and traders,
Uh-huh.
and I, basically what you were telling me your book is about is exactly what he was going over with us. And
Yeah.
I got to read this because I think a lot of it's going to hit home, and I'm just going to sit there and go, wow, this is just so correct. If you could tell us like how you implement your book into your company and tell us a little bit more about your company, that'd be great.
Well, ultimately, I determined that alpha, the pursuit of additional gain, which is what drives the egocentric nature of what people need to feel good about themselves, that alpha generation is sort of a fallacy. It's the smoke that gets into the process of discussion with clients that motivates them when they think they've met somebody who can figure out a way to turn all that to their advantage. But the reality is that there's 8,000 money managers and mutual funds in the US, and there's only 3,700 listed stocks. In the end, we're all working in a closed ecosystem, and most advisors are just generating friction in the process. People will buy mutual funds, and not only one, they'll buy a dozen of them. And in the end, doing so essentially assures them that they're going to underperform because they're going to end up stacking fees and taxes on top of a process that they're going to end up with an index return because of all the securities that are in the sub accounts that they are managing. And so I just determined that there was just too much friction in the process. And so considering that an 8% rate of return managed for taxes can generate another 300 basis points of return if it's generated in a tax efficient manner. And that process repeats itself year after year. So the whole process of trading for advantage and the pitch of the wealth management space to the investing public is all a fallacy in my estimation. Nobody is that smart, and I know they are not that smart, and I know I'm not that smart, and I am smart enough to recognize I am not that smart, and I am smart enough to recognize that focusing on fees and taxes is what's going to give me a repeatable advantage. And I turn that into how we manage money. So we have $1.4 billion of client money under management. We have $500 million worth of unrealized gain. Unrealized gain is the currency of success because the fact that you're deferring taxes, you're getting income on what would have been paid in taxes. You have currency for charitable giving and philanthropic endeavors. You get to realize losses when they are good for you to realize them. So managing the taxes underneath this is really a much more valuable part of the equation than whether Coca-Cola or Pepsi is a better buy today. That's a fallacy that people end up paying fees for, but it doesn't generate any incremental gain when the dust all settles.
Wow, thank you. And so I like what you said about having 500 million of unrealized gain there. Um, now in building your AUM up to 1.4 billion, do you mind telling the audience, how that came about? Was it done organically, inorganically?
Yeah, it's all organic. And on top of that, I'm a solo practitioner. I don't have any partners. So this is my firm, my book of business that I left UBS in 2010. I took about 275 million from them. And then it's just been, growth of the marketplace and growth of new AUM. We have about 50 million of net inflows per year. That's pretty much what we have averaged over that time period. So maybe 600 million, 700 million of inflows and another couple of 100 million worth of profits, maybe 300 or 400 million. So that's how we run it. And we have 9 GIPS compliance strategies. So the Global Investment Performance Standard is the institutional standard for performance calculation. So we have 9 GIPS strategies. So we have a rising dividend, tax efficient. We have the ETF. We run an aggressive growth strategy. We have a muni bond portfolio. We've got a low volatility that is a dividend-centric individual stock account that's low vol. We have lots of different ways, and so we slice and dice the client portfolios into those underlying baskets. And if the client needs something like small cap or some other type of vehicle that we don't run, then we'll use a mutual fund or an ETF for that particular sliver. But generally, we're running the portfolios because we want fee compression. We don't want client fee money going to a third party when we don't really feel that those third parties can add any value. So we charge
Gotcha.
one wealth management fee, but we deliver asset management services as part of that value proposition without charging a secondary fee for it. So we're going to be in the bottom 20% of fee percentage for across the institutional space. So
And if you don't mind me asking, how many advisors do you have underneath you there?
0. I'm the only advisor here. I have 9 support staff from business development to accounting to a CFO to operations to whatever. I have a staff PR and events person that manages my public persona, if you will, my social media and the like, advertising, podcasts, those types of events. So there's really 9 employees plus me and no other advisors.
Wow.
Oh.
Um, I like that. And if you don't mind me asking, what are your growth plans? You've built this up to 1.4 billion in the last 12, 13 years. Do you mind me asking what your growth plans or your possible exit strategy is?
I think that succession is probably the um, most difficult part of the business. I've been unable to recruit qualified advisors. I have a lot of people that want to be a junior advisor at my firm. They just want to come in and inherit my book of business without having to pay for it. And these
Right.
businesses are so valuable nowadays. I just really can't see how I'm going to be able to make the math of that work. So I would guess in the end, I would probably end up merging with another similar firm to mine, and figure out a way to provide succession for my clients that way, because in the end I feel that that's my responsibility, is to provide them a path forward. I'm 64, so I can't do this forever. I like it, I'm good at it, and I'm not at the end of my career, but I definitely am concerned about what that would mean if I were to get sick or have some kind of health setback. So that's number one on my priority list. But I do think I could grow the business to 2 billion relatively easily. It's just a matter of time. So that's kind of the way I would look at it.
Gotcha. Thank you.
So what impact do you hope to leave on the wealth management industry, both through your work and your book?
Well, I am a very transparent and truth-seeking person, and so when I, claim that I'm disruptive, yeah, I'm disrupting much of the status quo, because in the FINRA regulated part of the business, much can go unsaid that probably should be said. And I'm the one that's out saying what is and what is not. And people, I would hope, would gain some value and insights from what they didn't hear from their other advisor. So it's a business of omission as much as it is a business of commission. And so that being the case, I think that people who aren't telling the full story are vulnerable to people like me that are out there telling how things work and giving people a very frank analysis of the way fees and 12b1 fees and annuity costs and what's the value of tax deferral, and you have to give up a step up in basis in order to get deferral. So is it really in your best interest to buy that annuity? Those types of very frank discussions, I think, puts me in the catbird seat to be the trusted advisor to a lot of those clients.
Thank you. And so how would you measure success as a financial advisor? You are a little bit more
Well,
disruptive and different than other advisors, as you said. But how would you truly measure success as an advisor?
Well, there's always the math of the business. How much revenue are you producing? How much profit do you have? I guess it would be my impact on the community. I'm charitably minded. I encourage my employees to be charitably minded. I think that charity is a very important part of the risk management equation. People who are generous with their money tend to not do so out of abundance itself, but it leads to abundance. There's a very high correlation between people who are very good risk takers and people who are also very generous. So I also believe on the flip side of that, that clients who have a scarcity mentality oftentimes can be a hoarder. And when you hoard your assets, you generally are not a very healthy risk taker. You only want to take risk when it looks compelling to do so. And as soon as you get thumped, you're going to end up unwinding it because you never really wanted to take the risk to begin with. So we find people that have a scarcity mentality are really more of a saver at their core, but they don't really like the low returns or previous low returns. Now that treasury bonds pay a lot more, maybe they can get some compensation for it. But you have people who are greedy, who want the return of the risk profile that they're not willing to take. And those people enter the marketplace until they get spanked, and then they depart. And all that money that they lose ends up accruing to people like me who think in decade time periods and are not in a big hurry to liquidate anything. And so we caution people about taking risks that they're not willing to accept. And we try to provide a rational view of what should be expected based on the risk level that's being articulated. So anyhow, that's what I think would be the mark that I want to leave on the business is one of truth, integrity, and generosity.
So, I was gonna tell you there. You've went into what the vision of the future of your firm looks like. I was gonna ask, with you telling us the sectors that you like earlier, or that you've been interested in, what's your opinion on artificial intelligence? What do you think that that's going to do to this space and in general?
15 years ago, when I first heard the concept of a computerized interface that was going to replace the brokerage or advice business, I just didn't believe it, and I still don't believe it, because in the end, people want to be told what to do, and they don't want to be told what to do by an algorithmic model. And I always think that there's going to be space for a trusted advisor telling somebody the way they're reading the tea leaves and the way I would act if I were you, Mr. Client. And that people are willing to pay a fee for that. They do not want to be out playing golf, worried about the news that they just heard about, and have to interrupt the sanguine nature of the way they're living their life to be interrupted by something that they're concerned about what's going to happen. People do not want to be responsible for themselves. They want to pay an advocate to be thinking about them and thinking about what's going on in the world and making proper changes, all things considered, even including the taxes that changes would generate. So there's always going to be a space for that, and people will always be willing to pay a fee for it. And I don't think that the increased sophistication from AI is going to change that. The so-called robo-advisor was the original AI. And yes, AI has been stepped up a notch, but it doesn't change the fundamentals that people don't want to be responsible for themselves. They want to hire an advocate to do it for them. And
Right,
that's where
right.
that's the space that we're in.
Right.
Thank you.
So, as an expert in your field, Gil, what investments and sectors are currently capturing your excitement?
We like the energy space predominantly because I think the world has bought into an unbelievable set of circumstances with regard to the future of battery innovation and electrification of everything. And I see people riding around it, and I love Elon Musk, and I think he's brilliant, and I think he is going to change the world. But the world is not going to wake up 2 years from now, or by 2030, or whatever these green plans are, and all of a sudden be off of oil and gas. There is just no way. The technology is not there. The grid can't support it. What it takes to charge cars and what it takes to charge some of these semi trucks that they're building, the grid system is just not designed to support it. And I think people are going to have a wake up call some number of years from now with energy demand not changing a bit, and the lack of current production and the political discouragement from the exploitation of energy resources, we're going to have a shortfall. And when we have that shortfall, I'm going to be cashing my big old hunkin' dividend checks from the Chevron and EOG and Exxon and all the other names that we own, because people are living in a dream world if they think we're going to convert to green energy. I'm not doing it, and I'm happy that they're talking about it, because that is future return that I'm going to be cashing my checks on. So
Yeah, I
that's what
wholeheartedly agree with you.
that's what I believe about the future.
I love it.
Again, I wholeheartedly agree with you. I owned a Tesla for 5 days, and I almost torched it. Right.
Man, you cannot beat it for speed and power. My gosh, I
True.
rode in a Tesla Model S one time, and I was blown away by the
So
performance. And
fast.
I think the torque is just crazy, and I love that feature of it. But the practical reality of hopping out on the road and driving from here to Fort Worth. I live in Houston. I drive to Fort Worth sometimes. I have family up there. My gosh, I wouldn't get out on the road in an electric vehicle like that where I don't know where I'm going to charge it and how long it's going to take. I can't just I can't leave here with a quarter of a tank and then just stop along the way and pick up some fuel. It's just not a practical reality. So maybe someday we're going to have, electrification chargers everywhere along the way and batteries that will refill in 5 minutes. Maybe so, but that's not the world I live in today. And I doubt I'm going to live in that world in the next decade. So we're big believers in energy and natural gas, in particular natural gas. So
Yeah, the one thing I noticed during my 5-day ownership of a Tesla was, when it would tell me where the nearest station is, and I'd go there, and it didn't have an adapter for Tesla. I was like,
yeah,
why would it not have an adapter for Tesla? Almost every single EV is Tesla, right?
yeah,
And then
yeah.
they had them for BMW, and they had them for Volvo, but they didn't have them, and they had them for but they did not have them, and they had them for VW as well, but they did not have them for Tesla. I go to another one as I'm riding on 9 miles. It says I have, which was
Oh,
really 3, and then that
that's
one didn't
very
have it,
stressful.
right?
Very
And
stressful.
it was a
Yeah,
nightmare. And I said,
yeah.
this was, being, stranded on the side of the freeway was just something I was like, I can't do this. And so anyways, I pulled the thing over and I Ubered home, and, I asked my assistant, I said, I need you to get this car back to the dealership. I have a cool off period, thank God. And I
Yeah.
never saw it again.
And I see people driving around town here in Houston that have license plate that they are so proud of. They say no gas, no CO2. There's one in town that says NOCO2 as the no carbon dioxide. He feels so good about the greenness of his Tesla. Where did that electricity come from, Mr. No CO2? It came from the natural gas that the local power plant is burning to create that, or worse, coal, which,
Right.
all especially in the Northeast, when you say no CO2, well, that means you're not generating the CO2, but it sure got generated while it was, plugged into your battery charging it up. So the people live in this world where they're trying to exude this image of themselves about how I'm, superior to your way of thinking because I'm not generating CO2. Well, yes, you are. You're just not generating the same way I am. So it's just kind of a dream world that we live in, which is fine with me because the disconnects from reality creates opportunity for me. So I'm perfectly fine for them to live in their dream world if they want to.
So, given your expertise, what are your insights for near term and long term regarding the economic outlook? We have a lot of debt going on right now, more than America's ever experienced before. A lot of it's, has came on the last few years due to the pandemic. And, what do you feel is going to be happening with interest rates, the stock market, and just due to these circumstances that we haven't encountered before?
Generally, I don't like it. I don't like the depreciation of the value of our currency. I don't like the debt load that we've taken on. I don't like the rise in interest rates that we've seen, and it should have already put a lot of pressure on the equity market. That has not shown up. I'm a little fearful of an 87 redo. I don't know if you remember this, but in 1987, part of the cause of that 27% decline in the Dow that occurred on October the 19th of 1987 was related to the prior 10 months in which the long-term treasury bond had gone from a 7% rate to a 10% rate. And the marketplace for stocks really just kind of shrugged it all off. And then all of a sudden, everybody had the holy cow moment, and there was just this feeding frenzy of liquidating equities. Now, they ultimately came back and very quickly, but I do fear that type of volatility or some type of a sell-off when some news hits that the marketplace just can't digest. And I don't know whether it's a 10% treasury bond or an 8% or whatever it is. I just generally don't like it. Now, with large unrealized gains, how big a shift can I make? I can't go through it wholesale, start selling stocks and try to protect my clients from the potential for downside because I'm going to run them into the certainty of having to pay taxes on their
Sure.
unrealized gains. So we're just a little slower to invest capital nowadays. We do sell puts, so we have clients that would have cash that they want to invest at lower prices. So we have a put selling program for some clients who understand that type of a strategy that would help us deflect some of the potential for immediate downside. But we also, in the end, always believe, much like Warren Buffett does, that in 81% of all 12-month time periods throughout my lifetime and really through my parents' lifetime, stocks have gone up in
Yeah.
81% of all 12-month time periods. If you're not betting that stocks are going to go up, and irrespective of the backdrop, you're making the wrong bet. It is a very foolish bet to bet on the 19% of the time that you might be right. I know that it's very fulfilling and people are not risk seeking, but the reality is that if you're betting on that 19% prevailing, you're going to be making a mistake in 4 out of 5 circumstances. And so we just tend to bank on the fact that that's likely to prevail going forward. So yes, we are long-term equity owners.
You see any black swan events in the horizon potentially?
Other than the interest rate issue that it seems to be stacking up against my, philosophical leanings, I think that would be the catalyst that, could cause some problems once it just gets to the breaking point. Doesn't seem like the labor market has started to worry about it, and the current GM and Ford, the UAW. Being able to renegotiate their terms, and then you have the Writers Guild in Hollywood that has renegotiated their contract. So labor seems to have a lot of strength in the marketplace, and that bothers me too because that tells me that they're not fearful of getting laid off, which should be what everybody fears when you have rising interest rates, is the fear of recession. It's sort of the opposite is occurring. And
Right.
so that does bother me. And I don't ultimately know how it's going to play out, but we're just long-term quality buyers and, looking at the horizon a decade out and not, next month.
Thank you.
Well, Gil, your journey and disruptive perspective has definitely shed light on new horizons in wealth management today. Thank you for sharing your insights with us and joining us today. We really appreciate it.
Thanks for having me.
And to our listeners, thanks for joining in on another episode of the What Matters podcast. Stay tuned for more engaging conversations on wealth innovation in the future. Thanks so much. Thanks again, Gil.